Welcome back to Rekt Radio, the only place on the internet where market turbulence is just another opportunity to buy the dip. I'm Sunny, and folks, while others see fear, I see a landscape just bristling with coiled up potential. The future is being built right before our eyes.
And I'm Cole, here to remind you that what feels like a coiled spring can often be a rattlesnake getting ready to strike. There's a lot of activity out there, Sunny, but not all of it is progress. Some of it looks an awful lot like people running for the exits while the band plays on. Let's get into the details before someone gets bitten.
Never, Cole. You can't deny the energy, especially around Ethereum. It's been on an absolute tear, pushing towards that critical $4,000 level. And this isn't just retail mania. The data is clear. Capital is choosing Ethereum. The latest reports show institutional inflows into Ethereum products are outpacing rivals like Solana. This is the smart money making a clear decision about which blockchain has the real long-term utility.
I see the price pump, Sunny, but I also see a tidal wave of regulatory risk building on the horizon that nobody seems to be pricing in. While you're celebrating inflows, the European Banking Authority just dropped a bombshell. They're proposing that banks should apply a 1,250% risk weight to their crypto holdings. A 1,250% risk weight means a bank has to hold $1 in capital for every dollar of crypto on its books. It's not just a cautious proposal, it's a financial quarantine. They are essentially telling banks that holding this asset is so toxic they might as well set the cash on fire. That's not a foundation for institutional adoption.
But that's my point. That's the old world trying and failing to put the new world into its obsolete boxes. They do that because they're terrified. They know they can't compete. It doesn't stop the real innovation, which is happening on-chain, outside of those legacy institutions. While the bankers are shaking in their boots, DeFi protocols like Hyperliquid just smashed a new record, hitting over $319 billion in cumulative trading volume. That's a real, thriving, parallel economy being built, and it doesn't need a bank's permission.
You say thriving parallel economy. I say unregulated shadow casino. Hyperliquid is a decentralized perpetuals exchange. Celebrating its volume is like celebrating a casino's profits. It just means an enormous amount of high-risk, leveraged gambling is taking place. That isn't a measure of economic health. It's a measure of speculative fever. It's the riskiest corner of the market, and you're holding it up as a beacon of success. It just proves that the system is optimized for high-risk trading, not stable growth.
You see gambling, I see price discovery and liquidity. But fine, if DeFi volume isn't enough for you, let's talk about something even more fundamental: legal and regulatory clarity. The entire XRP ecosystem is buzzing right now because there's growing optimism that the SEC is heading for a defeat in the Ripple case. The price has been responding positively. This could be a landmark moment, setting a precedent that protects the entire crypto industry from regulatory overreach. That's a victory for everyone.
A victory for whom exactly? Because it certainly doesn't seem to be a victory for the people actually holding the token. This is one of the most classic, most terrifying divergences I have ever seen. While retail buyers get excited about courtroom rumors and push the price up, the XRP whales, the largest, most informed holders, are dumping their bags at an alarming rate. One analyst flagged that whales have offloaded nearly 1.9 billion XRP. They are creating exit liquidity by selling into the hype. They are cashing out while telling everyone else to be bullish. It's a textbook trap.
Or it's savvy investors rebalancing their portfolios after a significant price increase. It's not automatically a conspiracy, Cole. The bigger picture here is that a major player in this space fought the fight in the courts and looks poised to win. That sends a powerful message that this technology is resilient and here to stay. It forces a level of clarity that benefits builders and investors for years to come. You're focusing on a few wallets while I'm focused on the historic precedent being set.
I'm focusing on the people who have the most information, and they are sprinting for the door. They know the outcome of the case is irrelevant if the token's value proposition is weak. They are taking their profits off the table, leaving the hopefuls holding the bag. It's a sign of a deeply unhealthy market where the price is completely disconnected from the actions of the most significant holders. It's a house of cards, and the architects are quietly sneaking out the back.
Well, this is all part of crypto's grand entrance onto the world stage, and that includes the political arena. It's becoming a major election issue. The Trump administration is reportedly floating the idea of allowing crypto investments within 401k retirement plans. Think about that. Integrating the best performing asset class of the last decade into the core retirement strategy for millions of Americans. It's the ultimate long-term vision.
That is without a doubt the most terrifyingly irresponsible idea I have ever heard. You want to take the nest eggs of ordinary people, funds they absolutely can't afford to lose, and encourage them to put it into the most volatile, speculative, and manipulated asset on the planet? It's political pandering of the highest order, using people's financial futures as a cheap talking point. This isn't adoption, it's a recipe for a retirement crisis that will make 2008 look like a minor hiccup.
It's about freedom and choice. Nobody is talking about forcing anyone to do anything. It's about giving Americans the option to allocate a small percentage of their portfolio to an asset with asymmetric upside potential. And this is happening while Trump's new tariffs are creating shockwaves through global trade. In a world of trade wars and currency debasement, a decentralized global asset becomes more appealing, not less. It's the perfect hedge.
A hedge that becomes harder to acquire thanks to those same tariffs. Where do you think mining rigs and other crypto hardware come from? Those tariffs could create a massive shock for the mining industry, driving up costs and centralizing operations. You can't praise the political maneuvering on one hand while ignoring the massive operational risks it creates on the other. It's a chaotic, messy, and self-contradictory strategy that will ultimately hurt the retail investors and miners caught in the crossfire.
It's just the messy process of a new technology being integrated into the global system. But I know what you're thinking. Let's get away from the politics, away from the narratives. Let's look at the cold, hard data of the king itself. Bitcoin. I've got the one-day technicals from TradingView pulled up right now.
Oh, I can't wait. Please enlighten me. What story are the tea leaves telling you today? I'm on the page now, and frankly, it looks like a disaster.
It looks like an opportunity. Okay, I see what you see. The overall summary is flashing sell, but this is classic. This is what a market bottom feels like. It's when every indicator is screaming fear, when the weak hands have been completely flushed out, that you find the point of maximum financial opportunity. This isn't a signal to get out, it's a contrarian signal to get in.
Sonny, this is a new level of delusion even for you. This isn't just one indicator. It is a clean sweep of catastrophic data. The overall summary is sell. The oscillators, which measure short-term momentum, are on a hard sell. And your favorite metric, the moving averages, the one you always claim shows the deep, powerful trend, it's also flashing a sale. Every single dial on the dashboard, short-term, long-term, momentum, trend, is pointing directly down. This is not a trap. This is a 5-alarm fire, and you're telling people it's a great time to toast marshmallows.
It is the darkest before the dawn. When sentiment is this one-sided, it means the fear has peaked. The selling pressure is likely exhausted. A reversal happens when there's no one left to sell. This is the final washout. This is the capitulation that lays the groundwork for the next monumental rally. Buying when the charts look like this is how real wealth is made. It's the ultimate buy signal.
Unbelievable. You are looking at unambiguous empirical evidence that the market is in a downtrend, and you have managed to pretzel logic your way into calling it a buy signal. This is precisely how people get liquidated. They ignore the data in front of their face and listen to a narrative of pure, undiluted hope. The market is telling you with every tool at its disposal that the path of least resistance is down. It's not a suggestion, it's a warning.
That's all for this episode of Rekt Radio. I see a market that is cleansing itself of fear, setting the stage for a powerful rebound led by superior technology like Ethereum and driven by the capitulation in Bitcoin. Don't let them shake you out right at the bottom.
And I see institutional walls going up, insiders dumping on retail, reckless political games, and a technical picture that screams, "Get out." Don't be someone else's exit liquidity. Trust the data, not the hopium. You've been listening to Rekt Radio.